If your income is over $100,000, there are ways in which you can legally, ethically, and morally reduce that tax liability. There are multiple people that need to be in your circle. You have your CPA, you have your financial advisor. Do you have an advanced tax strategist? So we get why a CPA may not understand every incentive in the tax code. There's 77,000 pages of tax code. All of them are incentives. Understanding what every single one of those intent was for that particular code is going to be almost impossible.
I'm going to hand over these to you. Is there anything on these lists that we cannot at least speak about? Can we hypothetically talk about all these strategies?
Caleb, honestly, we have known each other for quite a while now, and this is a good opportunity to just tell the story. I break my programs into 4 categories.
First strategy on the list.
If you are an accredited investor, one of the financial instruments that we're using is a program in which we're able to become a beneficiary of carry forward losses.
How far back can you go?
Honestly,
this next strategy,
it's a business owner structure. We're able to use leverage to increase the power of that capital you put in and benefit from.
The next strategy is donation.
That category I call volume discount, charitable gifting, buying in bulk, and then
I was shocked to see this on here because maybe this is like unsetting and ending.
There's still some benefits of solar.
I'm telling you, this could be one of the most valuable conversations someone listens to all year when it comes to putting money back in their pocket. Roger Roundy.
What's up?
Welcome to Nashville, Tennessee. I've been looking forward to this conversation for a very long time, and here's why. Every time that the year comes near to the close, me and many other business owners are looking at our potential tax bill and getting this sick feeling in our stomach. And this is what ends up happening. You go on and you look at different tax strategies, and obviously there's the Augusta rule, which is a great strategy, and paying your kids, which is a great strategy, and deductions. And then you look on YouTube, and people are saying your wife or your spouse should be a real estate professional. And there's like, okay, there's some interesting tax strategies, but then you meet some people who really take it to the next level. You look at billionaires and the ultra wealthy, and you read news articles on how they're paying almost zero in taxes, and you just scratch your head and be like, they didn't do that because they maximize their deductions, writing off their cell phone. They are doing strategies that maybe the public doesn't know about. You guys are one of the best in the country when it comes to advanced tax strategies. And my mind, to put lightly, has been blown understanding and learning about some of the tax strategies out there that are available. And you are going to share some with us. I know Absolutely. We can't share. We have Mr. Compliance off camera who's going to like unplug the cameras if you start talking.
If I all of a sudden disappear, it's because you pulled me off the stage, so I get it. So.
But my hope in this conversation is for you to open up as much as you can about the frameworks, the philosophy, and more importantly, some of the strategies that people should be aware of. And then obviously there's firms like yourself and other people out there. But if people are aware that these strategies exist, like that's my hope and goal in this whole conversation is make people aware, increase their financial IQ, and hopefully we can save hundreds of thousands, maybe millions, maybe multiple millions of dollars. And I believe personally that the money will be better stewarded, not paid to the government. I know that could be a crazy statement, but that's my premise. And so I obviously want to just create a disclaimer before you even open up your mouth. We're going to be talking about lots of different tax strategies, options out there and all, but this is not tax advice. This is not investment advice. This is not insurance advice. This is not legal advice. This is for educational purposes only. And all the things that we talk about, do your own research, have your tax team look into. But I'm telling you that this could be one of the most valuable conversations someone listens to all year when it comes to potentially putting money back in their pocket. With that intro, Roger, welcome. And I hope you live up to the bar that I just said, because it's a pretty high one.
Major rock star. That's what the guys talk. That's what they call me. So, hey, it's a pleasure to be here, Caleb. Honestly, we have known each other for quite a while now, and this is a great opportunity to just tell the story, right? Because really, we live in an amazing country, United States of America. I mean, there's no better place to create value and be compensated for that value that we create.
It's the greatest country on earth.
I mean, I love it. Like, I fly a flag out front of my house. I drive a Ford F-150. Sorry for you Dodge guys, but
I I drive a Tesla, so
So Tesla, okay.
we equal each other out. Okay.
There you go. Perfect. But ultimately, as citizens of this country, we are blessed. And we all should pay as much in taxes as we're obligated to. But if there are incentives, if there's programs, if there's opportunities in which we can partner with the government to mitigate our taxes and be benefited for the actions that we take, why shouldn't a successful small to mid-sized business owner be able to do the same things that the Fortune 500 and the elite are doing?
Thank you.
Right? That's basically what you just said, right? But how do we do that? Because once you get to an uncommon income, it deserves uncommon planning.
It's good.
Right? That's what our firm does. Right now, you're going to see stuff on TikTok and YouTube and so forth that are slinging a specific strategy. That's not what we do. Right? The objective is to understand all your options.
Yeah.
I mean, there's nothing wrong with the Augusta rule or hiring your kids or having a home office, but those only get you so far.
Right.
But once your income gets to a certain level, then it's like, okay, that $10,000 deduction was nice, but I still have $300,000 of taxes. What do I do now? Right. So you mentioned this time of year, right? If you are not worried about your taxes this time of year, you have the wrong team, right?
Or you're not making enough money.
Or you're not making enough money. Either way. So
that's, I mean, there's a
right.
legitimate, like there's some people watching this that this is something that they can look towards. They can say, hey, like, hey, if you're not having a tax problem or if that's not a big enough pain, all good. But maybe you'll be in a place where that is the case. And then you can reference this conversation 2 years from now. So I just want to acknowledge that, we are talking to a group of people who do have uncommon income and an uncommon first world problem as many people. And it is a legit problem, but it's still, I think we can all acknowledge, is a first world problem. But that doesn't mean it's still not a problem.
Well, and here's what BetterWealth does is create vision, create opportunity. If you don't have the tax problem, your job is to go create the tax problem, right? Go make some money, figure it out, but don't be worried about, hey, if I make too much, now I'm going to have to pay too much in taxes. I hear that from certain groups out there. Well, you just made a lot of money. You're going to have to pay a lot of money in taxes. That is not the case. You go make the money. We're going to help you keep it, utilizing the incentives in the tax code.
Yeah.
That's the objective of BetterWealth, right? Hey, we're going to teach you financial strategies, teach you how to improve your overall existence through understanding the incentives, understanding financials, understanding everything that Caleb is doing such a good job teaching all of us. That's what we want to make sure that you're out doing, but then understand that there's team members that you can put on your team to help you maximize the income that you're making.
That's right.
Right? Because there are multiple people that need to be in your circle. Now, you have your CPA, you have your financial advisor. Do you have an advanced tax strategist? And once your income and once your tax bill is north of $75,000 to $100,000, then it's time to enlist an advanced tax strategist.
Okay.
That's really the threshold of where we start coming into play. And again, what our firm does is go and find these solutions. We vet them out. We have our compliance guy over here. He's the one that makes sure that if we're going to do a strategy, it makes sense and it passes the intent and confines of the code. But once a strategy is part of our suite of options, we're good. I mean, we've vetted these things out. We've gotten the legal opinions. We've done the executive summaries. We understand what's actually going on and what the incentive behind the objective is, so that we can then educate and help implement these particular solutions.
Right.
So overall, that's kind of the big picture. It's an amazing opportunity this time of year. Obviously, end of year is when you do tax planning. Don't do tax planning first quarter. It's too late for most things, right? But once you understand how much income you're going to have for the year, that's when you do your tax planning. And it's a lot easier to mitigate your taxes in the current year than the prior years.
That's right.
Right. Or after the fact, right?
There are strategies that can be done, but it's just you're a lot limited, and it's I think it's fair to say it's not as powerful.
Well, as far as our programs and opportunities, I mean, when we sit down with a client, our first thing is we're going to try to clean up any spilt milk, right? We take a look at 24, 23, 22. Did you have a very large tax bill from those prior years that you just didn't have a good team or a good plan on how to mitigate the taxes, so you just paid it? Because your CPA said, just pay the tax. It's fine, but we do have programs where we can implement a strategy to benefit from prior years.
Yeah.
So that's the first thing we're going to do. We sit down, we look at what the opportunities are, what your tax bill was, anything over $100,000 in any year. We're going to teach you a couple solutions that we can use to actually go backwards and recoup some of those overpaid taxes. That's our first step. Then after we clean up the spilt milk, we don't want to spill it again, Caleb. We don't spill the milk. It's much easier in the current
That should be
year,
a t-shirt, I think.
right?
Don't
I
spill the
think
milk.
we're gonna make some t-shirts. That's gonna be good. You're on that, Caden. You're it. So, let's not spill the milk, right? This time of year, we're meeting with the client. We're teaching them the opportunities. So whether it's K-1 income, 1099 income, if you're high W-2, maybe you sold your business, you have a large long capital gain. Let's look at the income, and then we're going to look at the 3 or 4 or 5 different strategies that make sense that we can utilize to help you reduce that tax liability on that income.
I love it. If you could snap your fingers and say everyone could understand how you think about taxes, not necessarily the strategies, but how you think about taxes, I would love that.
So I don't get too political, okay? But I do have one political statement, okay? Which is, if I can help you, Caleb, save $100,000, $200,000, $300,000 in taxes, very confident that you're going to be more fiscally responsible with that money. So that's my one political statement.
You're saying you can spend money better off than the government can spend your money.
You're going to be better at spending it.
Yeah. Okay.
Well, they're really good at spending it. It's just where they're spending it, I may or may not agree with. Right?
Yes,
so
I can get behind that.
Is that fair to say? Yes. Hopefully everyone can understand where I come from with
that. There will always be that one person. There will always be that one person. Please comment. We always read it. Right.
So, but ultimately, the objective is if there are ways in which we can keep that money, bring it back into your life, I believe you're going to help stimulate the economy. The way we're going to fix the economy isn't by sending more money to the government. It's by bringing more money back into the control of the small business owner. That's my personal opinion. That's how we're going to stimulate the economy. That's how we're going to fix things, is bring the money back into the control of the people. So if we can utilize the incentives in the code, partner with the government, like you said, utilizing the incentives in the tax code, then that's what our objective is going to be. Now, there's 77,000 pages of tax code. All of them are incentives.
Yeah.
Understanding what every single one of those intent was for that particular code is going to be almost impossible for any one human being to do. So we get why a CPA may not understand every incentive in the tax code, and that's understandable, right? But there are opportunities to utilize the structures we're going to talk about. So when we meet with a client, and I've been doing this for 15 years now, right? Started with one particular solution. It was just a slinger of one strategy, right? Which was fine. But as I got introduced to more and more people, I was also being introduced to more and more strategies. So more opportunities to say, hey, have you guys seen this strategy? Have you seen this strategy? Fast forward to today, we have 15 different ways in which we can help a client. So taking a comprehensive approach to tax mitigation strategies or programs or whatever you want to call them, they're just utilizing incentives that are available. I break my programs into 4 categories. Okay. So the first category, I just call business deductions. Everybody understands you buy more stuff for your business, you get to write it off, right? And there's various programs within that particular category. One in particular, and I'm going to throw it out there, is 831B private reinsurance. Really good program, but it's a business deduction, right? Now, the second category is probably our biggest category. I call business ownership with tax benefits, where we're starting a new business and that business is going to utilize the incentives in the code that incentivize small business owners to create, right? That's what that's what's so awesome about our country is we incentivize creation. So those first two categories are above the line deduction. And this is just a quick taxes 101, right? Everyone may have heard the term adjusted gross income, which is a combination of all your income types. Once you've established your AGI, you have deductions that are going to be above that line, and then you have deductions that are below that line. Those are your more personal deductions, right? And the personal deduction category, probably our largest, is what we call leveraged charitable gifting. Now, Caleb, have you ever given money to charity before?
Yes, I have.
If you give $10,000 to Red Cross, you get a $10,000 deduction.
Yes.
Well, we have programs, probably by now 5 or 6 different ways in which we can use the power of either volume discount purchasing or leverage to increase the power of your donation dollar to where you're getting a 1 to 5 or a 1 to 6 or even a 1 to 8 meaning you're putting in $50,000 to get a $250,000 charitable donation deduction. Right?
And that would be considered below the
That's a
line?
below the line.
Below the
That's a
line.
personal deduction, right? So that reduces your taxable income.
Right.
The other strategies reduce your adjusted gross income.
Right.
Okay.
Is there, from a tax strategy standpoint, is one better than the other, or are they both?
It all depends on the type of income, realistically, right? If you're a W-2, often we're just going to head right to the person below the line
Yep.
stuff. If you're a business owner, then often we'll go above the line. So it really depends more on the type of income and how much the income really is, because some of the strategies we use, you do have to have a higher income to be able to even make the math
Is that
work,
why
right?
people say that if you're a business owner, you have more tax options because you're dealing with above and below, whereas if you're a W-2, you only have below the line. There's strategies out there, but you're limited to that, whereas a business owner has all of those and all the above the line
That's
opportunities as well.
exactly right. That's why you hear that. And that's why people think, oh, I've got W-2. There's no way to mitigate my taxes. That is not true.
Okay.
Looking you in the eyes saying that is not true.
So if someone's a high-paid doctor or a W-2 person, they can have strategies out there that can save them money.
Silicon Valley loves us. There's a
Okay,
lot of high
okay,
W-2s,
okay.
okay? Just so you know.
New
right?
York will soon love
Yes.
you even more.
Right.
At the time of this recording, there's been not to get political, but there's taxes are going up in New York, and
Yes,
so
right. So high W-2s, bring them on, right?
Okay.
There are opportunities, and we definitely want to make sure that you understand what those opportunities are. Personal deductions, the first one, leverage charitable gifting. And then there's tax credits. For those who don't understand the difference between a deduction and a tax credit, a tax deduction reduces your taxable income.
Yes.
So if you had a $500,000 income, you get a $100,000 deduction, you're now at a $400,000 taxable income.
Yes.
A tax credit applies towards your tax liability.
Yeah.
So if you have $400,000 of income, you owed $100,000 in taxes, and you had a $100,000 tax credit, that wipes out the entire tax liability, right?
So credits are so much more valuable than a deduction if you're comparing it dollar to dollar.
If you're comparing dollar to dollar, absolutely.
Is it fair to say if you have a deduction and you're at a 30% tax bracket, just say, and we can break down brackets
Sure,
as well, because that's
sure.
a misunderstanding. So if you have a $100,000 deduction at 30%, that's an equivalent of a $30,000 credit.
That's exactly right.
Okay.
Yep,
So
exactly. Yep,
okay.
you've nailed it. So then there's other financial, the fourth category, other financial instruments, right? There's the one that we use to go backwards is a very common one that we use a lot. And that's more of a financial instrument, more of an investment that we're going to make that has tax benefits to it.
Okay.
Right. So those are the four categories. But once we understand really what type of income you have and how much it is, it's really easy for us to identify which strategies are going to make the most sense.
Yep.
If you're making $2 million a year, well, I know exactly what we're going to do. Right. If you're making 400,000 or 500,000, then we're going to look at some different options.
Okay.
Right. So
Got a couple questions for you.
Yes.
So you've said a couple times in our conversations that you believe in paying your fair share.
Absolutely.
So want to talk about how you figure out what your fair share is.
Okay.
And then also, this is another first world problem. People are they're not really going to feel a lot of sympathy for this problem I'm going to share next.
Right.
Is you can wipe out your taxes to a level where you actually, it's bad from a bank standpoint. So let's play an example.
Okay.
If I wanted to be really aggressive,
Yep.
hypothetically, I could make zero income. But then let's say I want to go buy a house, and then the bank says, "Hey, Caleb, you have no income." Now you can get manually underwritten. There's things that you can do, but
Sure.
that can be frustrating. So I know for myself, I have a number in mind that I'm like, I, number one, feel like if I pay tax on this number, I'm doing my fair share, and I feel like it sets me up for options in the future. And because my goal personally is not to get to zero.
No.
Some people, I don't necessarily think that's necessarily healthy or good, and it potentially creates a lot of issues. So that's not my personal goal. But after that number, my goal is to try to optimize as much as humanly possible. I'm curious, is that usually how you work with people, or how do you determine fair share? And then how do you determine how much income someone should have based on their financial goals or their life goals?
Right. So this is how I always say it, right? I personally try to keep my income, my taxable income, between $75,000 and $150,000 to $200,000 a year.
Okay. Another way to say that is if you pay tax on 150 to 200, you
I
check
feel
the
like
box.
I'm contributing to society. We all need to contribute. My kids go to school. I drive on the roads. We got to support the community.
Yep.
But I'm not going to pay $1 million in taxes because I have ways to mitigate my taxes, right? So if you have this really high income, should you really be paying $500 to $1 million? And that's a philosophical question, but my opinion is, as long as we're all contributing society, then we're doing our fair share. Okay? So that's the objective, never to go to zero, right? If someone wants to go to zero, I'm going to say, why, right? And honestly, at that number, you mentioned marginal tax brackets a little bit earlier, right? You don't really need to mitigate your taxes below 100,000 because you're not paying that much in tax anyway. So keep some on the table, right? There's no sense in going to zero because that tax benefit for the amount that you're spending to do that wouldn't really be worth it. So again, try to keep your income 100 to 150,000 to 200,000. You're still contributing to society. You're just not paying hundreds of thousands of dollars in taxes. When we sit down with someone, that's our objective.
Are there some people
Now,
that end up wanting to have a higher income because they want a nicer home?
so when you're talking about banking, right? So there's programs that we're going to utilize that do dramatically reduce your adjusted gross income. Most bankers are going to use adjusted gross income as what they're saying. Hey, your AGI is only $100,000 and you're trying to build $1 million house. You don't make enough money. Sorry. Right. Oftentimes, if it's above if it's those above the line deductions, some of those, once we educate the banker on what's actually happening, we can get them to add that income
I
back
understand.
in. Does that make sense?
Yes.
Right. So that's one thing is understanding how, making sure whoever's involved understands how we created that deduction. The other thing is, once your AGI is established, if you are worried about that, let's just say, hey, I need to keep my income up this year because I'm buying a house. Okay, great. We would more likely then focus on your personal deductions because once
Below the line.
below the line,
Yep.
right? Once you're at below the line, then leverage charitable gifting is a great way to still mitigate your taxes, but not screw up your banking. Does that make sense?
I understand.
So, but again, that all depends on what the situation is. There are some limits on the personal deduction side because with charitable gifting, especially, you can only write off 30, 50, or 60% of your AGI. So you can only lower it by half, but that half is still going to benefit you, but not mess up your AGI if you're trying to keep it high enough to build a bank.
Yep.
So
Another question that I have before we dive into some of these strategies is red flags from the IRS. People are so terrified
oh yeah.
of audits, getting in trouble. So I want to talk about how that actually works. Even if you want to mention, there's this thing called the dirty dozen kind of deal. Like, so some of those things, and then worst case, like just let's talk about that because what I've found is sometimes people are so afraid of a potential audit that they do nothing, and there's a cost to that. But then there's a legitimate cost of doing a strategy that potentially triggers problems. And so pretend like I know nothing about how the IRS works, how auditing works, and let's break down the risk because nothing is risk free. You obviously are doing things to try to be as solid as possible, but I think it would be unfortunate if I didn't at least mention that in this conversation.
Oh, thank you. Appreciate that opportunity to kind of tell you how I work, right? And that it's not how all firms like mine work, right? But before I'll represent a structure, I've done a lot of due diligence to make sure that it's protected, that it's at least past the smell test, and a lot more than a smell test. But we just make sure that the program does have a legal opinion, does have executive summaries, does have some real intent, some economic substance, all the things that the IRS is going to look at when you've reduced your taxable income dramatically. How did you do that and what was the intent behind it, right? But so that's why I'm comfortable with the structures because of our due diligence on the front end. And I'm comfortable enough to say an audit is not the end of the world. Yes, they're not fun, right? And when I hear, oh, I don't want to be audited, I understand no one wants to be audited. But what is an audit? It's an IRS agent wanting to take a look at your tax return and say, well, tell us, make sure you accounted for all your income. And did you overtake deductions that maybe that you shouldn't have taken, right? Do what you're supposed to do so you don't have to worry about being audited, right? I mean, an audit is not this horrible, like, oh, it's the end of the world unless you're trying to hide something,
Right.
right? And often people are so afraid of being audited because maybe they didn't keep track of their miles exactly the right way. And maybe their home office isn't as big as it was, as they're saying it is. Or maybe they didn't really hire their kids. Those little dumb deductions, not dumb, I apologize. They're fine.
Another T-shirt,
There's no dumb deductions. But ultimately, I'm not afraid of audits for one reason. I'm confident that we've done our due diligence on our programs that we represent.
Yeah.
Now, if you're doing something shady on the back end, Caleb, and it's not part of what we're helping you do, I can't help you there, right? But it's not really, with our programs, the way I like to say it is, it's not a matter of, will this get me audited? Because I can't tell you yes or no, right?
It's will this stand up?
Will this stand up? Who's there to defend my audit, right? Because the IRS could question anybody's tax return. I can't tell you yay or nay, right? So it's not a matter if you're going to be audited or not, is if you're audited, who's there to support and defend the audit. So how we work is Strategic Associates has an audit support warranty. It says, look, if you're audited, which an audit typically starts with a letter from the IRS saying, hey, you have a deduction we'd like to know about. That letter you send to me, we check out, see what they want to know, and then we turn it over to the tax attorney who defends that particular structure. Again, we have lots of structures, so depending on which structure it is, I typically require that if I'm going to promote a program,
that there's an attorney.
There's a tax attorney who's defending that strategy at no cost to me, no cost to you, and no cost to the client, right?
Okay.
So that's, otherwise there's no sense in me promoting their strategy. I've got plenty of options. There's literally hundreds of ways to mitigate your taxes. I want to use something that's clean, legitimate,
Right.
easily defendable.
And again, how many clients would you say that you have helped over the last 15 years?
Like, just mitigate their taxes? Yeah. It's in the thousands for sure, right?
Out of the thousands, I'm sure many people have been audited. Just running numbers.
Truth be told.
Are you serious?
Yeah.
Which is a blessing and a curse.
Well, we've had a couple inquiries, we'll call them,
yeah.
right? When the IRS has sent a letter saying, hey, we need to know about this deduction, we turn it over to the tax attorney to send it back. That's happened like twice in 15 years.
And why do you think that is?
Do good and be good. Just do the things that you know are not going to trigger.
But even an audit doesn't even mean that people that are doing legitimate things will get audited it's a matter of luck, we'll say. It's a matter of understanding that your likelihood of being audited isn't as high as people would like to think it would be, right? It's way less than 1%. I'd say 0.05%. Is it possible that some of these strategies also that are being used are not, there's some strategies like tax easements that increase your likelihood of being audited by a lot? If you don't do things like that, is it possible that some of those are even, it lowers even more than the average audit on that?
Some of the structures you're pre-auditing yourself because you're sending the paperwork that the IRS would want to see anyway. 831B is a prime example for that. You actually submit the form that they would want to know anyway. So you're telling me exactly you're pre-auditing yourself. You're giving the information that you would need. Again, all the different structures, there's lots of different things we're doing.
Okay.
But yeah, I mean, to date, we've been very, very fortunate to not have to fulfill on our warranty, right? Because we just don't get a lot of audits. I believe it's because we're doing things that are pretty easy to see from an IRS perspective. Oh, we understand what's going on there. But again, that's just a luck of the draw. Anybody could be audited. But we're willing and able to support and defend the audit if it happens. But your risk of being audited is substantially less than the risk of you just paying the tax, right? You pay the tax, you 100%, you've lost the money, right? Yes. You said it earlier, right? You have 100% chance of loss if you just pay the tax.
Yeah, and just to also be clear, my next question, which is not going to be a great question because you've had very few scenarios, is like, out of the people that have been audited, how many people have been having to pay back tax with penalty? That would be my next.
So let's go to the programs, because the programs, a lot of the programs we promote, there have been audits in those programs. So just because my firm hasn't been audited or none of my clients have been, doesn't mean that the programs that we're promoting, they have been audited, right? Now, not dramatically, not a huge number of times. Every time there's an inquiry on a particular program, the IRS will reach out, and then the attorney who defends that program will reach out to the auditor, and they take care of it on that end. Now, that's happened multiple times, let's say 20, 30 times with all the different programs out there, if there ever was a loss or someone did lose their audit, we obviously wouldn't keep promoting that strategy,
I understand.
right?
Okay.
And
So is
so
it fair to say all the strategies that you're currently
I don't have
talking about have not lost an audit?
correct
Okay.
100%.
Okay. With all that said, and I just want to just take a quick break and just say we're going to get into some high level strategies
Yes.
on YouTube. If you want to learn more about the details, we will have a link down in the description. And this is where we're going to go more into detail, but we can't put this on YouTube for obvious reasons. And there will be some qualifications that need to be acknowledged and checked. If you actually want to go deeper, you actually have a team member that we're going to go behind the scenes later on like all these strategies in depth. But on YouTube, I would love for you to be able to give everybody high level examples of some of these programs. And so um, I have a list of some of them, but I'll let you talk
Okay.
around. And again, we're looking at high level. None on this list is how to write off your cell phone or how to better track your mileage. We're not saying that's bad. We're just that's not on the list. Okay.
Right.
So these are things that are, if someone does, and you would say that you shouldn't even consider these strategies if you don't have at least a $75,000 to $100,000 minimum
Mhm.
tax bill.
Yep.
So if you don't have a $75,000 minimum tax bill, these strategies might be good to know about, but would not be something that you should even consider this year because for many reasons, it's just not worth the time and energy to go establish that. If though you check the box, have more than $75,000 to $100,000 and up, these could be really powerful strategies and should be at least known about and potentially brought to their tax team to look into.
And to hit on that, go make that problem. Right.
Exactly.
That's
Welcome to America.
that's you live in the greatest place on earth. Go create the problem, knowing that, hey, you're going to have a guy who's going to help you maximize the income you're going to create.
Yep.
That's to me the beauty of just understanding our economic situation we're in the United States of America. You can go create.
Yes.
You can go make money.
I love it.
And once you do, let's chat. But also, just to hit one thing on that, if you anticipate making more money next year, it may make sense to still have a conversation this year because we can prepare for next year.
I understand.
Does that make sense?
Yes.
So there is one particular solution. We're not going to dive into the actual particulars, but just know if you're anticipating something happening next year, maybe you're seeing to sell your business next year or something like that, it's always good to prepare if you know the plan that it's going to happen. Right.
I'm going to hand over these to you. Is there anything on these lists that is on here that we cannot at least speak about? Obviously, we won't name anything by name, but can we hypothetically talk about all these strategies?
We can talk about all these strategies as far as a high level overview. I'm not going to give them names or anything like that. And obviously there's disclaimers in our compliance guys here. So we got to make sure we say things.
The camera hasn't been on yet, so we're doing well.
So we haven't said anything yet. We're still all talking at this point, but I know people wanted to get to the meat and I appreciate that. It is a YouTube though. So we got to be a little bit careful. We can't just mass produce everything, but if we were just to say on a to the world, if your income is over $100,000, not your income, your tax liability is over $100,000, there are ways in which you can legally, ethically, and morally reduce that tax liability. It's understanding how these programs work, understanding that they have to be done within the intent and confines of the code, and that you need to be working with a group that understands how to make sure that it's implemented on the front end and also is going to be there for the long run.
Yes.
I'm the oldest guy, I hate to say it, by 15 years in our firm, right? So we have a good, solid team of young bucks that are going to be here, and we'll meet one of them here in a minute. But it's understanding that there are ways to do this, but go make the money. That's to me better wealth, right? Go make better wealth. So.
All right. So the first one, I don't know if I can even read the top, but you know what it is. Talk to me about hypothetically first strategy on the list. If you're an accredited investor and want to find a place where you can look at all the advanced tax strategies that I know or if I've been pitched or I've heard, I've created a place for you. It's called taxandassets.com. It's a free community for accredited investors that want to go deeper on potential tax strategies for you to do research on, for your tax team to do research on. You can go to taxandassets.com or check out the link in the description.
High level, if you are an accredited investor, I just want to teach what that means, just to make sure everyone understands. And I know this is kind of mass produced, but when you hear the term accredited investor, there's two qualifications to become accredited investor, right? If you're married, your income for the last 2 years, if it's over $300,000, you're an accredited investor. If you're single, $250,000 for the last 2 years makes you an accredited investor. That's the first way you can classify as an accredited investor. The second is if you have a net worth outside of your primary residence of over $1 million. Most of the things and most of the people that we're talking to or want to help are going to be accredited investors. So if you fall into one of those two categories, that's where you most likely have a tax problem too. So that's why you'd want to have these structures, right? So if you are an accredited investor, one of the financial instruments that we're using is a program in which we're able to become a beneficiary of carry forward losses from prior years. So this is a program that we're using to go backwards. So during COVID, there were large financial institutions that didn't do really well. And we all know the effects of COVID. It was a big deal, right? Well, 2021, the CARES Act is allowing these institutions that didn't do well and they created huge operating losses on their books to carry those losses forward indefinitely. But if you have a business that has all these losses sitting on their books, well, how do you monetize that loss, right? Well, you can't just sell your losses to people, but you can use a financial instrument that allows you to participate in those losses. Because the losses are sitting inside of a trust, you're able to become a beneficiary of the trust that has those losses and a pro rata beneficiary of those losses that you can then take and put on your tax return. Okay. That program, and you said it earlier, it's not our most powerful strategy. When we say powerful, we just mean how much capital do I have to put in for the amount of benefit I'm going to get? But let me ask you something, Caleb. If you could turn $75,000 into $100,000, how many times would you want to do it?
Every time.
Every time. Okay. As many times as you could. It's the more appropriate answer.
Yeah.
Okay.
Okay.
Not to tease you too much, right? So the limiting factor is your tax liability. So if you have a tax liability over $100,000 for 22, 23, 24, or 25, we can utilize this financial instrument to get a guaranteed 33% return on your investment.
That word guaranteed can be a dirty word, but
I know you live in the whole life insurance world, so I can say some guarantees, but it's tax planning.
Okay.
Right? You're putting $75,000 to get $100,000 of tax benefit.
Yeah.
Well, 33% return on investment with no market risk
I understand.
is a very healthy return and no taxes because you're just mitigating your taxes. So
why don't you just summarize? So it's like, before we go on to the next strategy, just summarize the whole thing for people.
So on this particular structure, it's a financial instrument that creates a 33% return on the investment that you're making. Anything over $100,000, we can get a 75 cents on the dollar return on that investment. And it's a very protected program. That's why it's a little less beneficial.
Right.
Right.
But
and
the benefit is you can go back.
You can go back.
Whereas a lot of these strategies, you can't do that.
A lot of them we can't go backwards.
So another way to say that is, if hypothetically I paid $100,000 of tax that I in the past, like $100,000 in tax, and I could potentially put $75,000 in and be able to get 100 back.
That particular program,
in this scenario,
you are amending your tax return, and that amendment is going to result in a refund from the IRS.
Okay.
And
I find that that's really powerful. A lot of times, most people don't even know anything what they can do going backwards, and that's something. How far back can you go in something like this?
So we can go back 3 years from the day you file your tax return.
Okay.
So we're pretty much past everybody's 2021. But we can go back to 22, 23, and 24.
Heard. Okay. All right. Let's talk about this next strategy. This is a strategy that you mentioned to me years ago, and you've been doing. And so, high level, without saying, what it is. Talk to me about this. So
this program, it's actually the one I use for my own tax planning. It's a business owner structure, and we're able to utilize the power of leverage. Now, you've heard the term OPM.
Yes.
Other people's money, right? When you use leverage, it enables an opportunity for you to utilize capital that you're putting into a new business. Use leverage to increase the power of that capital you put in, and benefit from and expense allocation using Section 704B of the tax code. What this program creates is about a 1 to 8 reduction of taxable income in year one.
Wow.
And creates a little bit of interest income for the rest of the life of the structure. This is a deferral strategy.
Okay.
So let's talk about deferral versus mitigation, right? So when I say deferral, it means you're taking income from today and you're kicking the can on that income down the road, whether it's 5, 10, 15, or indefinitely, right? Meaning you're not claiming that income, you're claiming the income, you're just creating a deduction for year one, deferring the income down the road. Okay. If you're just reducing your income without any deferral, that's a different type of solution, right? But this program in particular is a deferral 16 years at a time.
Okay.
We're kicking the can 16 years down the road. And if available, we're going to kick it again 16 years down the road. My plan with this particular structure is to kick the can down the road until.
What's the phrase? It's buy, borrow, die.
Yeah. Right.
And I mean, not just.
That's a very common real estate program.
Yeah,
this particular structure, if those who understand, the tax mitigation world, because I'm sure there's some here, I look at this one as a combination of the same types of benefits of bonus depreciation and 1031 exchanges.
Okay. So
right?
Bonus depreciation meets 1031.
In real estate, you're getting bonus depreciation and you're doing a 1031 to kick the can down the road until you pass away, right? With this program, same thing. It's not bonus depreciation. It's a different mechanism to create the same benefit of bonus depreciation. We're getting a very large reduction of taxable income in year one. You're getting interest income all the rest of your life. And then when you pass away, because of the step up in basis, and I'm not sure if we want to go that deep into the program today, but there are opportunities to be able to defer.
Right. And even let's just say worst case scenario, you don't defer. And at the end of you said 16 years, you would then just have to pay tax on
up the income in 16 years.
Okay.
Right.
So worst case scenario in your scenario is you pay the income that you're already going to pay 16 years from now, or time value of money and all. Best case scenario is you can continue to defer, or who knows what tax strategies are going to be available.
16 years, maybe use a different strategy to mitigate the taxes at that point, right? But that's the main point with deferral is, Caleb, and this, I guess we just will go here anyway. We're going to talk about philosophy on tax mitigation dollars, right? If I help you save $100,000 today, it's not to go buy a fancier car or a nicer watch or a bigger boat.
Though people will do that.
They will do that, and that's fine. But honestly, my suggestion would be take the money, put it to work.
Yes.
Put it someplace safe, secure, growing with ancillary benefits. Turn that $100,000 into 2, 3, 4 times that in 16 years.
I agree.
Now you have plenty of money to pay the tax if, in fact, you do end up paying the tax in 16 years.
I agree.
That's the concept of deferral.
Yeah.
Okay. And everybody needs to understand, guaranteeing to pay a tax bill today is substantially different than a tax bill 16 years from now.
Yes.
Even with inflation, the power of that is going to be substantial.
And for those of you that want more info,
yes,
we will have more info. It just can't be on YouTube. And so, yes, there's no more questions I'll ask at this time.
With that particular program, there is an income limit. It's usually for the bigger incomes, 800,000 of ordinary or $1 million of capital gain. Okay. But this is my go-to for large liquidity events.
So that means if you sold a business, sold
a piece of real estate, and you have a long-term capital gain, this is the strategy we're most likely going to use. So hit us up on that one for sure.
The next strategy is donation.
Yes.
Talk to me. You alluded to it a little bit earlier, but this idea of leverage donation. So for example, if I want to go give to charity, I give them $50,000. Just say I have $50,000 deduction. It's pretty clean. I give 50. Have $50,000 deduction. It's my understanding that you can actually create some type of leverage deduction that, in hypothetical, you give 50, but you actually can write off more than 50. Why don't you break down what that means?
There's lots of programs out there. Can I show a device? All right, he's there. All right. All right, fine.
We've
So
already, just so you know, whether this makes the tape or not, we've already been shut down a couple times from Mr. Compliant. No fun in the corner over there.
Mr. No Fun.
Keep it us out of trouble.
Luckily, he's an awesome guy too, so it's okay. So overall, the concept of volume discount purchasing. Caleb, why did we go to Costco or Sam's Club?
I love Costco, by the way.
Okay.
You go to Costco because you can buy
Plug
in
for
bulk.
Costco. We get,
Yeah, you can buy in bulk, and as a result, you can get a cheaper unit price on that bulk,
So if you go to Costco, you buy a box of candy bars.
which I will never do.
Well, okay, whatever it is you buy a lot of, okay, you're getting them for 50 cents a piece.
Sure.
If you go to the convenience store, that same item might be $2.50
Yes,
a piece,
I
right? So
heard.
that's the concept of volume discount purchasing. Pretty much the entire universe understands what it means to buy in bulk. Okay, this category, it is a personal deduction. It's a charitable gift, so it's reducing your taxable income. It's not reducing your AGI. So these are good for if you need to keep your AGI high, but you still don't want to pay a bunch of money tax.
This is for people that below the line.
Below the line, especially high W-2s.
Okay, high W-2s.
Yes.
This is
a
fair
great,
game. Okay.
fair game for sure. And everybody else, but it's particularly beneficial for high W-2s. How it works is every year, we've been using these structures for years now. Every year, there's usually a different product or service or program where we're trying to get it out to the market, right? And in order to get something out to the market, if you buy a lot of that product, you're going to get a volume discount. So the product we're using this year, we're committing to literally $50 to $100 million of a piece of something.
Wow.
Well, when you buy that much of something,
You get a discount.
you get a pretty good discount, right? Now, when you buy that product and you donate that product, the IRS allows us to take
The grocery store.
the grocery store price, the convenience store price, right?
The gas station price.
The gas station, yeah, exactly. So the appraised value of that item, right? And the appraised value is typically the retail value of the item. So if you're buying it wholesale and donating it retail, you're able to take the donation value of that item is reducing your taxes by the retail value or the appraised value of that item, right? Same in those, stockbrokers out there. A lot of you have heard about donating appreciated stock, where you bought it at a certain price.
Another way, I mean, it's common that art. People have heard about art. Art can be a little bit subjective because it's like, how do you value a piece of art?
Right.
But it's a similar concept.
Concept.
You have art, you donate it, and you donate it on the appraised value, and it may be more than what you paid for it personally.
Exactly. That one is a little more subjective for sure, right? But it's definitely certain that something you can do. They can do it with pretty much any item. What we create are opportunities to do this in a very clean, legitimate way that's streamlined and simple, right? That's our whole process. Right? We want to make you mitigating your taxes as simple and streamlined as possible. So each year we're finding these products and programs, vetting out, making sure it's all designed appropriately, that there's appraisals and everything, and there's an actual receiver of the product and all that sort of thing. So that category I call volume discount charitable gifting. Okay, where we're buying in bulk and then donating at the retail price. Okay, very simple. I like those structures because there's really typically not a lot of back end to it, right? You're doing the structure, you donate the product, and you're done. There's no follow up. There's no future income.
16 years from now,
exactly.
So it's more immediate.
More immediate and terminated. Like it's you're just one and done.
Okay. All right. So this next strategy, it's my understanding that you're taking the power of bonus depreciation, and it looks very similar to real estate, but it's my understanding that this is not technically real estate. But it's my understanding that you can take the power of bonus depreciation, leverage, but then it also has a specific trust structure all meshed into one. Just for the record, I've had videos on here that I've told people to avoid scammy trust setups. Okay.
Yep.
And I would love for you also to break down how that, because it's totally different. We're not talking about irrevocable spendthrift trust and all, but it's what's interesting to me is you get leverage, you get participation, and then you also get a really unique asset in the mix. And it seems like a pretty interesting strategy. So from what you can say on YouTube, why
Yeah.
don't you break down what the strategies are?
Hey, if you're a business owner watching this video, taxes are likely your largest expense. We help business owners all over the country keep more of what they make with proper tax planning. If you're serious about keeping as much money from the government as legally possible, then book a free tax analysis call with our tax team by clicking the link in the description or tag comment below. Back to the video.
So I really like this program because it basically benefits both business owners and W-2 owners,
Okay.
employees. And basically it's the one we go to if your income's in that $300,000 to $800,000 range. It's a very, very powerful solution. What you're doing is you're buying an asset that we're going to be able to use bonus depreciation, that big, beautiful bill benefit that we just got back. Thank you,
Trump,
Mr. Trump. So we're able to, for those who understand bonus depreciation, and you're buying an asset, and over time, the IRS allows us to depreciate our assets and take a little bit of deduction for that. Bonus depreciation just means that we're able to accelerate all of the depreciation benefit and put it into year one.
Yes.
Okay. This asset, we're buying the asset. And typically in these types of programs, there's tax terminology that we need to make sure we're understanding, and it's material participation, economic substance, and the long-term recapture of depreciation. One of the problems with depreciation is you have to do what's called recapture the depreciation if you sell that asset. So if you buy a piece of real estate, bonus depreciate everything, you sell it in 3 years, well, guess what? You have to pick that income back up, right? So that's always a consideration. Oftentimes people talk about the back end of bonus depreciation. With this asset, we're buying the asset through a unique structure where we're actually participating in a trust that's going to buy the piece of the asset. Okay. That trust structure, because you're partnering with the manufacturer of this asset, you're able to benefit from their material participation classification. So you're participating in the trust that's buying the real estate that allows you to become a material participant in the transaction.
Whereas, just to try to simplify this,
Right.
If I go buy a regular home, even if it's an investment property, I would not be able to 100% bonus depreciate if I didn't have certain qualifications.
A real estate professional license.
Yes. And so that's one of the reasons why it's such a big deal on YouTube, is like how to do this.
Right.
What you're saying is the trust allows you to get that real estate classification because the people managing the trust and operating the trust.
Exactly.
And so you're able to, and I'm looking at compliance guy. Am I able to say this?
Close enough.
But you're getting the benefits. You're getting the benefits. So, well, don't sue us. Okay, we're just talking on a podcast. It's educational purpose only, but it's like
an entertainment podcast,
yeah,
right?
It's an entertainment. It's very entertaining.
Yes,
and so it's just my understanding that you're getting. You don't have to necessarily go through all those hoops individually. You're getting some of those benefits by doing a program like this.
Yes, it's because of the unique way it's set up.
Okay.
Right? So
okay, moving on to the next one, solar. I feel like I was shocked to see this on here because. Maybe this is like sunsetting and ending. Solar, I was like a big deal, in the past, and I feel like Trump has a thing against solar. So talk to me about, enlighten my brain about how
there's still some benefits of solar.
Okay,
we're using one particular structure, and this, hopefully this podcast gets out next week or two, because then that's the only we're starting to run out of opportunities there. But just so everybody understands how solar worked and what the benefit was or is still. There are tax incentives for you to put solar on your roof, right? Caleb, if we put solar on this roof right now, there's 2 tax benefits. The first is the cost of those panels that you put on the roof. They're able to be bonus depreciated.
Okay.
Right. So you're able to take the cost. Let's say they give you a 60% reduction of taxable income because it costs you $20,000 to put the panels on your roof. So you get a depreciation benefit. That's a current year benefit or a forward year benefit. The other benefit of solar are what we call investment tax credits, or solar tax credits, a lot of people will call them, right? Where the government is giving you X amount of dollars based on the amount of the value of that project that you put on your roof or a commercial project, whatever it is. So there's 2 benefits, depreciation and tax credits. Now we talked about deductions versus credit. This one actually has
both of them.
Right.
Okay. So you get, boom, you get to write off the money that you put in.
A portion of the money that you put in. Yep.
And then you also get a credit.
And then you also get tax credits that you can apply to.
And those credits are going away.
They're becoming dramatically less.
Okay.
Yes.
Okay. Heard.
What actually ends up after all the fun games that these guys have, we'll see, right? But currently, it is an actual one of the structures we're using. And if you are listening to this, it's probably a better hurry up and call us basically type situation where, because the tax credits, the benefit of the tax credits is that they apply towards federal tax liability, not your state. The depreciation will reduce both your state taxes and your federal taxes. Of course, we're in Nashville, so we don't have to worry about the state piece of that. So if anybody wants a good tax strategy, come live next to Caleb. No, no state tax in Tennessee, or Florida or Texas or any of those other places. But that's one really good tax strategy. But the tax credits themselves, they're applied towards federal liability. You have to apply them to this year. But the one thing about these types of tax credits is they can actually be used for prior years.
Oh, interesting.
Yes.
Okay.
So up to 3 years in arrears, and you actually have to go back 3 years, apply them as many as you can to 22, and then you apply them to 23.
This is very similar to another strategy we talked about, and you would actually get a check back.
Yes, absolutely.
Wow.
Yep. The nice thing about the solar tax credits is you don't have to file a complete amendment to your return to be able to apply them to prior years.
Okay.
So solar actually can be very beneficial as long as the benefits are still available, right?
Okay.
So depending on when you're listening to this.
And is it one of those things, if like you live in a state that it's not very sunny, there's certain aspects of you would also want, I would imagine having solar on your home also is an efficiency, personal efficiency.
Sure. Yeah, we're not talking specifically about you and your own home.
Okay, this
right?
is not,
we're partnering with a group that goes and sources these projects that you're buying into.
Okay, that makes sense.
I mean, the benefits are the same if you put them on your own house.
Yes.
But you're talking about substantially less benefit.
I
but
understand.
if you want tax benefits for putting solar in your house.
It actually makes a lot of sense, because when I was running the math on doing it here, I was like, yeah, I get it, but it just didn't make sense. But you're saying that there could be a greater advantage, maybe not doing it indirectly.
Using a third party that goes and sources the right projects that have the best benefits.
Okay.
Because there's certain areas of the country where you have more tax credits based on where the project is and who's sourcing the panels and certain things. So that's what we make sure that we're participating in. So,
all right, the last strategy on this list is something that gets, I feel like, talked about a lot, and I cringe a lot of times when people are talking about it, because I've actually seen, probably out of anything that we talked about, this can go south if it's not set up poorly, or if it's set up poorly. But we're talking about captive insurance.
Mm-hmm.
And this, again, I feel like it was a couple of years ago. I feel like a lot of people are talking about it was like the go-to strategy. So talk about captive insurance and how that works, when it makes sense to set up, and the pros and cons.
So the tax code is section 831B. Okay. And a lot of people have heard the term captive, right? A captive insurance company is you're creating your own insurance company, right? But an alternative to creating your own insurance company is to create what we call a reinsurance company, which is reinsuring another insurance company. But just to take a step back, 30,000 foot view of the incentive behind 831B insurance is that we all have risk. I have risk, you have risk as business owners. You have a huge reputational risk. I have a huge reputational risk. Well, Caleb, do you have a reputational risk insurance policy that you purchased from State Farm?
No, I actually don't. No,
because it doesn't exist.
Okay.
So the point is, we all have risks, or business owners, and this is a business owner deduction, right? If you have a business and that business has risks that you can buy insurance to protect some of those risks, but there's other risks you just don't have insurance to buy.
Yeah.
It's not out there. It's not available. And Congress knew that. So in 1986, they said, you know what? We're going to create an opportunity for you to protect that risk and provide an incentive for you to protect that risk through allowing you to create your own insurance company. So the money you take out of your business, put into your insurance company, is going to be tax deductible, necessary 162, necessary ordinary business expense. So the money you pay from yourself and put into insurance is tax deductible.
Just like if I were buying a business liability insurance policy.
Your E&O policy is tax deductible, right?
Okay.
Same thing. We're just creating insurance policies to protect the risk that we don't have other options to buy insurance for, the gap insurance, right? Things that are just non-insurable, like reputational risk. COVID made my life really easy because everybody understood what a contingent business interruption is or a supply chain interruption is, right? We didn't have insurance to protect that, but if you had your own private reinsurance company, you could have pre-funded
Yes.
for that risk. Does that make sense?
Yes.
So it's a very commonsensical code. I know that's not a real term, but I like to use it.
That word
It may be.
means,
Go look
yeah.
it up. It might common sense, right? It's common sense, right?
Yeah.
So to me, it makes sense for Congress to incentivize you as a business owner to
Yep.
protect your own risk, right? Give you a deduction for setting that money aside to create a war chest to protect yourself in case bad things happen, which we all know they do, right? The benefit is you get the deduction for the money you set aside. Inside of this insurance company, usually the policies are 1-year insurance policies, just like your car insurance is a 1-year insurance policy. Well, once the insurance policy that you wrote on yourself or you paid to yourself to protect yourself, after 1 year, that policy expires. Whatever you paid for that policy, if you didn't pay any claims out, that money is now sitting inside your insurance company as profit to your insurance company. The difference is your insurance company is a C Corp. Okay. For those who don't know, C Corps, they're taxed twice. They're taxed on the front and they're taxed on the back. On the distribution of the C Corp, that's taxed as a long-term capital gain. The 831B election, when you put the money into your insurance company, allows it to not be taxed until you pull it out. So you're taking money from your business, you're writing it off, putting it inside your insurance deduction, reducing it by 40%.
Yep.
Sitting it over here, creating a war chest to use for potential risk. When you pull the money out, it's taxed as long-term capital gains, 15 to 20% instead of 35 to 40%.
I understand.
That's the incentive for protecting yourself.
That's right.
It's just in this space, it's just like anything in our country.
Yeah.
I mean, all tax codes can be used, overused, and flat out abused, and captives have been abused. They weren't creating actual insurance policies. They weren't acting and looking and feeling like insurance companies.
It needs to be legitimate insurance. There needs to be a portion of your premium that actually goes to some type of reinsurance to actually insure if something happens.
There has to be real policies. It's that simple. And you have to be careful what you do with the money when it's sitting over here.
And this would be, you have to make a lot of money to qualify for something like that.
So typically what I say here is your gross revenue for your business needs to be north of about $2 million, right? And plan on putting about $200,000 or more into your insurance company each year. But again, that $200,000 is a deduction.
Okay.
So 831B is a great strategy. I've been doing them for 15 years. It's how I got into this industry.
Okay, so this was like the strategy.
I'm an insurance professional by trade, right?
So what you could do here is you do this, and you can also stack some other benefits. The beautiful thing is, it's a lot of times it's a combo of these strategies that make up a diversified tax strategy.
Absolutely, right. Most of the time, we are going to try to look at stacking. I call it just because there's limitations to each one of these will have a limitation. So depending on your type of income, it may make sense to do two, right? Or if we can do it all one, we'll simplify it. But
as we land the plane here, anything else that you want to say? And again, I just want to remind people you can give your disclaimer as well. Like anytime I have an episode with someone, there's open doors, risks that I'm taking. And I just want to acknowledge, like, for the longest time, I decided not to have this conversation because I just out of fear. And this is, just one of those, like, last thing I want is to, make a video and then it lead to someone and it makes them worse off. But then I was challenged recently to say, okay, but you not saying that, there's also something that maybe not is, you can't necessarily quantify, but there's also a risk of, like, they're just going to go find it somewhere else or straight up not be helped. And so this is my delicate dance of bringing on people. I brought on people on my channel that I straight up disagree with, but I believe having conversations with, and then all arranged. And so I'm grateful for you coming on. Any disclaimers that you have and any final thoughts that you had or anything that we did not mention in our conversation that you're like, this would be really great for YouTube. Obviously, we'll have your contact info. We'll have the link for our more deep dive. And if there's anything else that you guys have, but is there anything else that you want to say as we wrap up this conversation? I'm very grateful for you taking time to travel here to share this. I feel like, I don't want to be biased, but I feel like this was one of the most comprehensive interviews I've ever heard you or anybody else in your world do. And so I really think that this is going to resonate with lots of people.
Well, humbled and grateful for the opportunity. Like really, Caleb, you've done an amazing job with BetterWealth. So, but here's what I like to say, because a lot of who we work with are their financial advisors, CPAs, tax attorneys who come to us for access to solutions. And we've created an opportunity for BetterWealth to refer business to
Right.
strategic associates.
Financial professionals can work with you and be rock stars by allowing their clients not to be qualified for family offices to get access to this.
Exactly. Right. And also, I like to maintain a level of arm's length transaction. Caleb is not presenting an 831B and said, hey, you should go do this.
We're in trouble
right?
if I'm
keep it separate, right? Caleb's just giving me an opportunity to tell my story, right? So this is not BetterWealth saying, hey, you need to mitigate your taxes. This is Roger Roundy coming on Caleb saying you need to mitigate your taxes. Hopefully that you understand what I'm saying there is separate yourself from being the one who's presenting or promoting the
Another way of saying this is there's two types of people watching this. There's person A that's like, hey, I need to talk to someone about helping me personally. And then there's person B to say, hey, I have people that need help and your firm helps both of those type of people.
Exactly.
Okay.
Yeah, we can go direct, or there's a lot of financial advisors and life insurance agents who watch this podcast. I know that a lot of them know us already, but those who don't, we are providing opportunities for you to create a relationship where you can provide value to your clientele.
Cool.
Right. So, but we do want to make sure we separate that. You're just making an introduction to a firm. You are not the one presenting the structures. It's just that's a disclaimer that I would think would be very helpful, because if I help somebody and then it gets blown up, then it doesn't come back on BetterWealth. It comes back on Roger Roundy. Not that anything's going to happen, but just in case. So the other thing is, honestly, we do have a stewardship when it comes to the amount of money we're making, right? And for you to maintain that control, because that's one of your 4 C's, right, is bringing the control. If you'd like to take control of the income that you're making, that's what we'd like to provide the opportunity to do. Again, legally, ethically, and morally, making sure that we're doing things within that intent and confines that the code was created for. So I appreciate the time. It's been super fun.
Can you help people in New York City?
I'm really popular in about 6 states: California, Minnesota, New Jersey, New York,
New York City. If you're in New York City and not moving, this could be a valuable combo.
Who knows when you're actually watching this? But ultimately, hopefully things have settled down since that all happened this week. So,
Roger, thank you, and very very much look forward to what the future holds. Thank you for coming on, Sharon, and grateful for you.